TradeTheNBI.com. This is John. This report is for the 7th of December, a day that will live in infamy. Not sure that they talk about that all that much. And you can see what happened here once we got the magenta dipping below yellow. Cyan was already above. Steel continued to drop. And checkout continued to move, now negative. So that's a flip to bearish. And we see the gold that was rising that gave strong indication. Once the shakeout started weakening, the gold started rounding off. And so the momentum of that upside push completely lost, and all of that spike from Powell's comments gone because the realization is setting into the market, and you're seeing it through bonds and that as well, that the expectation for a significant recession is being well priced in, at least from a bond market standpoint. The market in general has not priced that in. Otherwise, we'd be far lower than we are right now. But when you had too many people positioned all in the bearish side, the counterplay was the right move, and that's something that we discussed, particularly with the Santa rally. And it's not to say that we're not going to see any turnbacks within this. All it did was fill back this spike. It wasn't quite a positive extreme; it was yellow, but those usually fill about 80%. Even yesterday's middle move down at the 61% would have been sufficient for that, but it kept going a little bit, and so now we have the 61% next. And white MBI leading at this particular stage hasn't really accelerated much. So a lot of this is defensive. And the problem with also in the Treasury situation is you're going to get a lot of people flocking to safety. And that's also going to cause a little bit of a yield. But you've got this huge inversion curve between twos and tens, and that really creates a problem because the market is forecasting these huge reductions in interest rates, and when they'll come, yeah, uh, Fed isn't indicating that it's going to stop. And we talked about this before. I mean, it was always my impression that they were going to go for an attempt to normalize rates, knowing that it would cause some economic pain, and they figured that they could, resolve it. Plus, you had the war; they could blame it on other elements, and those were features. Again, in my view, the oil dropping was going to be the key, and we'll look at that one in a second. The NQ looking pretty much identical, but far worse from a shakeout standpoint. And you're seeing that in the tech route, which is also interesting because you see all these layoffs and everything taking place, and yet, no changes in unemployment as it relates to anything. And there really hasn't been an increase in new business starts or anything like that. So it's the numbers are strange, and nobody believes. Particularly this time of year is always the same because there's always these seasonal adjustments that they do. And here you see the Treasury is pushing up towards that 100%. Now reached it on the declining Morganacci lines, which tends to want to pull it up to the 100% wherever it finally meets once it starts its decline, and still within a bullish trend, and that's unusual because you're reducing your yield, which ironically is the exact opposite of what the Fed is doing. So that's a pre-pricing of falling interest rates. It hasn't happened, and it doesn't look to be happening, but they're suggesting that maybe by the middle of the year next year it will have to happen, and that's being optimistic. I would call that a gamble more than an effective trade. But this move on oil is helpful. They talk about soft landings. The lower this starts to move, the less pressure it puts on other elements. And it doesn't mean that there still isn't going to be an increase from an inflationary standpoint. And the question is if there's a series of layoffs and whether or not wages are really increasing. We won't know that for a little bit longer, or whether it was just a momentary spike because of severance packages and that increase the hourly wages. We'll find out. But in general, it's the expectation is that obviously there's going to be some degree of slowing. The question just is how far, and will it push things into serious recessionary areas. I mean, we've seen now already from the middle part of April and that, where we had the what I would call the first recession, which was very brief because they were able to really use a lot of the excesses that had been built in, staved off a lot of it. And as you really suck that out of the consumer, that's when it finally hits. And I said it could take 6 months, a year, or longer to get rid of some of that excess that had been built up. And I think that we've done that. We've seen it with the energy prices having sucked so much from the economy and savings and things like that. Um, you finally have that tipping point, and obviously it starts on the lower end and gets hit the hardest first, and that's going to continue, and it'll take much longer before the middle and upper end because they've made so much with the easy money in that. So it has different effects, and that dynamic has to be understood in order for you to really grasp why, like I said, certain areas will be impacted more. And you're starting to see reports of that now. To me, it seems obvious, but clearly not so much from a news standpoint, because there are the subtleties that this kind of action has created. And when I say this action, we're talking about the massive quantitative easing, which everyone talks about, but there's no abatement in deficits and everything else. And so you're just playing this shell game where the Fed loans the money that, and the profits from that then get paid back to the Treasury for the US because they're two separate entities. And it just is, you're basically throwing money out, expecting people to still value it the same. And that's where gold comes into play because this idea of gold 3,000, 5,000, not unrealistic as you reach a certain point of perpetual deficits and ever growing huge interest payments that you begin to realize that currency, is devaluing on a daily basis. Um, and then you get these kind of games that central banks play with, uh, pumping and moving dollars and reserves to help prop up other currencies so that there doesn't become too big an imbalance. And we saw this with the euro, but also with oil prices dropping, the euro definitely has to rise simply because there's no longer that massive need, and not to mention the fact that Fed stepped in and aided them. So from that aspect, the euro potentially has more room to move higher simply because of that. And there's not that big a drain. Now, it doesn't mean there's any economic growth happening in the EU. And the EU is already talking about being softer on their interest rate rises because they already see how the uh, economic performance is, because the war in Ukraine has drained a lot of their capabilities. And winter literally is just beginning. So we haven't really seen the full effects of that yet. So everyone else is going to be the next comment. Well, crypto, go to crypto. Well, FTX really took the wind out of that sail in a big way. There was some excitement building up, and we could see it happening as there was a consolidation above that 16 plus range, and it started to make a little bit of move, and then the FTX thing took place, and I think that's going to have a long-term effect on how long it will be before people regain a confidence that aren't already committed crypto traders. We'll see. It's still an alternative and still being used. So from that standpoint, still viable. When we look at the 50K, it's been straight down last couple of days. We're not really seeing anything. We still have white spike, so we're still expecting a move down towards that 39.21 range. A little bit further to go intraday. Um, there was nothing to even talk about. I mean, the sell signals came in, and it just continued all the way through. And every little spike that popped up was just a big move, barely to get yourself over the 23%, and then an immediate crash of the MBI Magenta, leading to further decline. So it was really just this little uh, stared attempts, and every time they were just rejected, and then we got below the key algo levels that were already pre-marked. Actually, I'll slide over a little further so you can see what those values are right there inside the 39, 38 range there. And towards the end of the day, of course, build up for some profit taking, as well as short cover for the weaker hands who got in a little bit late, thinking at the bottom is when I'll start the action, because they're not seeing what we're seeing, but that's okay. And then here in pre-market, as soon as Europe opened, we started to see softness already. That's continuing. So there you have a broader economic look of things, and what to expect is Probably a little bit more of the same softness, but I think there's still going to be plenty of bounce plays in between there because, again, the position is going to get overplayed, and every time they do, and you find an imbalance, um, it's going to revert. And there's still plenty of trading time left before we flip to the new contract, and then also, towards that holiday lightness as traders take off and things like that, and that will create some broader swings as we head towards the end of the year. As always, though, trade well. We'll talk in later.